Hello, and welcome to How Tariffs Impact Your Customs Bond Sufficiency and How to Avoid a Freeze on Your Importing. I'm Nick Esposito. I'll be your host today. I wear many hats here at TRG, but one of my favorite roles is that of an educator to both my fellow coworkers and you, my audience of importers, exporters, and other international trade professionals. Joining me today will be Ben Oman. He is a licensed customs broker and underwriting manager here at Risk Guaranty. He has also been heading up our bond sufficiency project, so this topic hits very close to home. Also joining us today is Rachel Bowman, who is TRG's bond claims manager. And finally, TRG's vice president of underwriting and production, Jaron Anderson. This presentation is put together by Risk Guaranty Brokerage Services, LLC, or as we're commonly referred to as TRG. We're located in the heart of downtown Bozeman, Montana. For those unfamiliar with Bozeman, Montana, it's nestled right above Yellowstone National Park in southwestern Montana. If you're ever in town, don't be shy. Stop on by the second floor of the historic Rocking R Bar building. Our direct-to-importer business model is unique to the customs bond and cargo insurance markets. We've grown our business over the last 27 years to encompass over 10,000 clients from all avenues of international trade. As an important disclaimer, the information in this presentation is for informational purposes only and is not intended and does not constitute legal advice. We will be recording this webinar and it will be available on YouTube for future reference. To be notified the moment it releases and to keep a pulse on TRG's educational videos, I highly recommend you subscribe to our YouTube channel. Finding our channel is as simple as typing Risk Guaranty YouTube into Google and clicking the first result. If you have any additional questions outside the webinar, or if you'd like to be a part of a community of trade professionals, join our Facebook group, International Trade Professionals-TRG. We regularly check the group for questions and encourage our members to start conversations amongst themselves if they have a shared problem. All right, here's Ben to kick it off.
Thanks, Nick. One clarification here before we get started. We will be talking about the C1 importer bond. There are a few different customs bond, but this is the main customs bond that we're going to be focusing on today. So what is bond sufficiency? Before we fully get into the topic of bond sufficiency, we should really start with the basics of bond amounts and how they are calculated for U.S. importers. The bond amount, which is also known as the penal sum of the bond, refers to the maximum compensation a surety bond provides to the obligee per bond period in cases where the bonded entity doesn't meet its contractual obligations towards the obligee. In the case of a U.S. Customs bond, the bonded entity is the importer of record and the obligee is the U.S. Customs and Border Protection. Now, the penal sum of the bond is determined by the obligee and the type of surety bond it is. Therefore, the minimum amount a business must be bonded is ultimately determined by U.S. Customs and Border Protection. However, there's a formula importers can use to determine the amount they should be bonded for based on their importing practices. The bond amount should be equal to the total annual duties, taxes, and fees a business pays, or 10% of that amount rather. The resulting number from this equation is then rounded up to the nearest 10,000, with the minimum bond amount for an importer bond being 50,000. For a more in-depth look at how to calculate your bond size, please check out our YouTube channel for specific videos on the topic. When we mention that the bond amount includes annual duties, taxes, and fees paid to customs, there are some more specific components that are also included in this calculation. For example, any anti-dumping or countervailing duties, the new tariffs that recently went into effect, including Section 301, 201, and 232, harbor maintenance fees, merchandise processing fees, and any excise taxes you might pay. All of these should be included in the calculation of the bond size for your company so that you have considered all and any monies paid to customs. So on to the main topic. What is bond sufficiency? Bond sufficiency refers to whether or not the bond is adequate to protect Customs and Border Protection's revenue and ensure compliance with applicable law and regulations. Customs considers a period of the past 365 days from the current date when calculating bond sufficiency. Therefore, if you're considering if your bond is sufficient, you should ask yourself, does my bond amount cover 10% of the total annual duties, taxes, and fees paid over the past 365 days? If the answer is no, then your bond would already be considered insufficient and you'll have to place a new bond with Customs that has a higher bond amount. If the answer is yes, You must still look at how much of the bond's capacity you are using in case you are getting close to being insufficient. For example, if you have a $50,000 bond on file because you pay less than $500,000 in duties, taxes, and fees annually, but for some reason you have already paid $450,000 in duties, taxes, and fees over the past 365 days, you would have already used 90% of the bond's capacity and may need to get a larger bond on file soon. One common misconception when it comes to bond sufficiency is that it is reset when a new bond is put in place. That's not the case. Customs will always look back over the past 365 days when calculating your bond sufficiency. If we go back to that previous example in which you had a $50,000 bond on file, but you have already paid $450,000 in duties, taxes, and fees, you would have already used 90% of your bond's capacity. In order to ensure that you do not exceed the capacity of your bond, you may choose to increase your bond from $50,000 to $60,000. However, when you terminate the $50,000 bond and place the new $60,000 bond on file, the capacity for that new bond does not reset. This is due to the fact that Customs is always looking back at the past 365 days, and that amount would stay the same regardless of the bond you have on file. Therefore, in this example, you would have already used about 75% of the bond capacity of the newly placed $60,000 bond. There are also some additional factors CBP uses in determining whether the amount of the bond is sufficient. These include the principal's prior record of paying duties, taxes, and fees, and the principal's prior record of complying with CBP's demands for redelivery. In both cases, CBP may require an importer to have a larger bond on file if they have shown a record of non-compliance. The value and nature of the merchandise involved is also considered to determine if there is higher risk associated with those goods. CBP also considers the degree and type of supervision you will need to exercise over the transaction, the principal's prior record of honoring bond commitments, including paying any liquidated damages claims, and any additional information contained within the bond application. Basically, Customs wants to ensure that the importer has a history of compliance and may require a larger bond amount on file. Customs will also require a larger bond to be placed if there's any outstanding money owed for past importing. In these cases, the larger bond will typically be required until the outstanding money has been paid. CBP will periodically review each bond on file to determine if it is adequate to protect the revenue and ensure compliance with applicable laws and regulations. If a bond is deemed inadequate or insufficient, the principal and the surety will be notified in writing.
Thank you, Ben. That was a very good introduction into bond sufficiency. My name is Jaron Anderson, and I'm going to talk about how tariffs impact bond sufficiency. Recently, we have seen a greater number of bonds being deemed insufficient. Why? Well, this is largely due to the current tariffs in place. So, let's look at how these tariffs are impacting bond sufficiency. Over the course of 2018, there have been a number of tariffs imposed on imports into the United States. This includes the Section 232, 25% and 10% tariffs on steel and aluminum imports worldwide with country exclusions. This also includes the Section 301 tariffs on imports with a country of origin of China. These tariffs have had a wide-reaching impact on U.S. importers, with some businesses going from importing duty-free commodities to suddenly having to pay 25% duty on their imports. This is having a drastic impact on the bond sufficiency because if the duties you pay on each entry used to look something like this, but now the duties on your entries have begun to look more like this, you can quickly see that you will be using up the capacity of the bond a lot quicker and will most likely have to get a larger bond in place to cover the higher duties being paid. Alright, and that's a quick overview of how the tariffs affect bond sufficiency. For more on the tariffs themselves, check out our previous webinars.
Thanks, Jaron, for that insight onto how tariffs impact bond sufficiency. Now let's look at what happens when a bond is deemed insufficient by Customs and Border Protection and go through some examples of what you will receive from Customs. If Customs and Border Protection deems your bond insufficient or has determined that your bond will be deemed insufficient, they will send the principal and the surety a notice in writing. This is known as an insufficiency letter. This letter will inform the importer on what the minimum bond increase must be, when the bond will be deemed insufficient, and a general reason for the insufficiency. Recently, we have seen the typical timeline for insufficiency change due to the new tariffs. When you receive an insufficiency letter, it will contain information about the current state of the bond and instructions on what must be done at this point. In the case that the bond has already been rendered insufficient, you will not be able to import into the United States until a new bond has been placed. In these cases, the previous bond must be terminated before a new bond can be put in place. This can be very disruptive to an importer's supply chain, as any entries currently in transit will be stopped at the port. Since it typically takes 15 days to terminate a bond with customs and get a new one on file, an importer in this situation must act quickly in order to mitigate the impact. In these cases, customs will typically allow you to apply for a fast termination of the bond, but ultimately this is up to the discretion of CBP. In most scenarios, a sufficiency letter will contain specific instructions on when the old bond must be terminated and the new bond must be in place. In these cases, imports will still be allowed under the previous bond until the time frame specified on the letter has passed. At that point, the bond will be deemed insufficient. Now let's look at some examples of bond sufficiency letters that are sent by Customs and Border Protection to importers. We are going to start with an example of an importer that experienced a normal increase in the amount of entries they made in a year, which resulted in an increase in the amount of duties, taxes, and fees they paid annually. This increase resulted in the bond approaching insufficiency and Customs sending out a letter requesting an increase in the importer's bond amount. On the right, we have a screenshot of the entire letter so you can see how these are formatted, but on the left, we have zoomed into the top portion of the letter so that we can point out some key components. We've also redacted any personal information with the black lines you see. First off, if you look at the line items highlighted in red, you can see that this bond that was on file was $1.4 million. Then, in the last sentence of the second paragraph, it states, "You must terminate this bond and replace it with a new continuous bond with a limit of liability not less than $2,100,000. This means that CBP requires the existing bond with a bond amount of $1.4 million to be terminated and a new bond be placed with a bond amount of $2.1 million. If you look at the information highlighted in yellow, we can see that this letter was sent out on September 15, 2017, and that the bond was already rendered insufficient. In this example, the importer's bond was immediately deemed insufficient and they were unable to import into the United States until the new bond was placed. This resulted in a major disruption in their supply chain, which was not remedied until the new bond was placed, a process that can take up to 2 weeks. As we discussed earlier, a bond increase can be required due to any existing debt the importer has outstanding with CBP. In this example, the importer had a bond on file with an amount of $200,000. However, due to the fact that they had an outstanding debt of $1,820,524, CBP required them to increase their bond amount to $300,000. Here we can see the increased letter that the importer received from Customs. In red, we see their existing bond amount and the requested increase to $300,000. Highlighted in yellow, we can see that this importer had within 15 days from the date of the letter, March 10, 2017, to terminate the existing bond and get a new bond in place. If they failed to do that by April 9, 2017, their bond would be rendered insufficient. In cases like this one where the importer has an outstanding debt, if the importer does not want to increase their bond, they could choose to pay the outstanding debt instead. Once the debt has been paid, Customs will no longer require a bond increase. Now let's look at an example of an importer that experienced an increase in the amount of duties, taxes, and fees they paid annually because of Section 301 tariffs. In the areas highlighted in red, we can see that this importer had a bond on file with a bond amount of $1.2 million, and that Customs is requiring them to terminate the bond and place a bond on file with a bond amount of $1.5 million. Now, it's important to note that the calculation of this new bond amount is only considering a time frame of the past 365 days. They specify this in the orange highlighted area. On this sufficiency letter, which is a more recent example than the last two, Customs makes a point to warn the importer to consider their importing practices over the next 12 months to determine if a bond with an even higher bond amount might be more appropriate. The bond amount suggested by Customs on these letters is actually referring to the minimum bond amount Customs requires the importer to have on file. If the importer looks ahead to the next 365 days and determines that an even larger bond amount would be more appropriate, they should place that larger bond to avoid issues with stacking liability. We will go over stacking liability in the next section of this presentation, but it is important to note that Customs is only able to base their assessment on the information they have, which is past data and not a forecast of the future. Now, if we look at the areas highlighted in yellow, we can see that the importer was given a time frame of 30 days from the date of the letter in order to get a new bond on file. They also specify when the old bond must be terminated by in order to give the importer a more realistic time frame to avoid a disruption in their supply chain. One thing we have not covered on these examples is where customs states the reason for the insufficiency. The exact placement on the letter may vary, but each of the examples contains a section that looks like one of the two examples here. In this section, customs points the importer to a web resource that will state the reason for the increase and specifically mentions a formula described as either Reviewers 1 or Analytical 2. Reviewers 1 is the most common reason stated, and it refers to when an importer has imported more than the current bond's capacity, while Analytical 2 refers to the cases when an importer has outstanding money owed to Customs and Border Protection.
Thanks, Rachel. One of the other effects of bond insufficiency is that the surety experiences stacking bond liability, and that's what we're going to cover next. Stacking liability is also referred to as stacking exposure, and it occurs when a surety company has open exposure over multiple bond periods for a particular importer. That typically means that in addition to the current bond on file with Customs, there can be prior bonds or bond periods that have unliquidated entries. Since a bond period stays open as long as there are unliquidated entries under the bond, the liability to the surety also remains open until all those entries are liquidated. Therefore, the liability on the multiple bond periods open stacks. This creates significantly more risk to the surety that has issued the bond and typically results in the surety requiring additional collateral in order to place the new bond for the company. Here's a very general graphic illustrating how bond liability can stack and how that increases the amount of open liability to the surety. Now, this is a very general illustration and doesn't take into consideration certain factors like suspended entries that would occur when you make entry of merchandise that's subject to anti-dumping or countervailing duty. But here we can see that if you have a $50,000 bond in place and you have to increase your bond amount mid-bond term to a $300,000 bond, the open liability to the surety between those two is $350,000. So even though the $50,000 bond is terminated and a new $300,000 bond was put in place, the liability for the $50,000 bond would remain open until all the entries under it have liquidated. As a quick reminder, liquidation is Customs' final assessment of money owed for an entry based on the current knowledge of duty rates and the value of the imported goods. Typically, that process takes 314 days. So this process of stacking liability can continue to escalate if another increase was necessarily shortly after the first one. The open liability would continue to stack for the surety, making the business riskier overall. This can lead to additional collateral being required in the form of a cash deposit or an irrevocable letter of credit. If we go back to look at an example of an insufficiency letter sent as a result of a normal increase in annual imports, we can once again see that Customs is only requiring an increase to the next bond size. In this case, the company was issued a required increase to $600,000 up from $500,000. So simply the next increment above what the current bond level is at. In this situation, the increase in payments to CBP in a year was probably a more gradual process that may not continue to increase throughout the next year. So going up to the next bond size may be enough to keep the bond sufficient. In this next example, however, we see that Customs is requiring a minimum increase to a much larger bond than the one previously on file. This is due to the fact that this importer was drastically impacted by the Section 232 tariffs. Also, at the time of receiving this letter, the bond had already been rendered insufficient. Therefore, we can already see that a more substantial increase in the bond size might be necessary. Most likely, the increase in tariffs will continue into the coming year, and if you have already paid enough in duties, taxes, and fees to need at least a $1.1 million bond, the conclusion can be drawn that you'll exceed the bond's capacity within the next year. Therefore, this importer should really take a look at what size bond would be sufficient and forecast into the future the bonding needs of the company. If you only do the minimum increase on your bond and then are required to do another increase shortly thereafter, you will begin stacking liability to the surety. As we've discussed, the stacking liability leads to greater risk for the surety, which typically translates into more collateral and more cost to your business. Thank you for attending. We hope you've learned quite a bit about bond sufficiency and how it affects your business and how the surety sees it.
Thanks, Ben. Now I'd like to take a moment and talk about TRG. Risk Guaranty is an international trade insurance agency. We work directly with importers and exporters, and we've been doing this for 25 years. We've got over 13,000 clients that we work with every day, specifically discussing these complex topics and helping them navigate through the world of customs. We're an additional resource alongside their customs broker and freight forwarder. Our business model does help save time and money, and our multi-year billing cycles are significantly less on the customs bond. Typically, people are paying somewhere around $500 for their customs bond. With TRG, we get that down to $225 a year on our multi-year pricing on that $50K bond. You can continue to work with any broker or forwarder of your choice, and if any issues arise, then our in-house claims assistants from our licensed customs brokers are going to help you. Thank you for attending our webinar. If you have any questions, please don't hesitate to reach out to Ben directly by email at benjamin.oman@traderiskguarantee.com or via our Facebook group, International Trade Professionals-TRG. Additionally, check out our blog, traderiskguarantee.com/TRGpeak. It's got a treasure trove of excellent articles and information. Don't forget, you can find us on Facebook, Twitter, LinkedIn, Instagram, and most importantly on YouTube. If you'd like to be notified as soon as new videos release, make sure to subscribe to our YouTube channel. Again, thank you for attending the webinar.